disclaimer, I think whatever that we prepared today, whatever that I'm going to be talking about is solely based on our own research and of course our own experience. Any other questions that you have during the presentation itself, please feel free to just drop a note into our Q&A box. We get a moderator to answer, or even I myself will probably take some time to answer. Okay, I think one of the questions, and I think mainly what a lot of consumers have in their mind in the past several months is on how COVID-19 has affected the market. I think at the start of the circuit breaker in April, there was a lot of speculation, there was a lot of media attention, because this pandemic is not something like we've seen before. I mean, we've gone through H1N1, we've gone through SARS, nothing, it's nothing quite like the COVID-19 situation. I think, a lot of virus was expanding, and we've seen a lot of speculation, especially in the month of March. We didn't realize that it would hit our shores that quick. But I guess, the government did what they need to do at this point of time. During April, I would say, that was the start of the circuit breaker. I think a lot of us, had to stay home. There was a lot of quarantines. And I think a lot of economies were under very big scrutiny as to whether or not they would survive. Of course, real estate being one of them. And this slide, as you can see, is just an article of what, speculators and the media represented the market at that point of time. So they expected developers to sell about 20-30% fewer private homes than they did in 2019. And some analysts actually predicted up to 8 full-year drop in terms of private prices. I think as we move along, I would like to explain the story as it is. I would like to explain the scenario as it is. So just bear with me. So again, at the start of circuit breaker, there was a lot of talk. There was a lot of media speculation in that sense. During the start of circuit breaker. So I think as far as the circuit breaker is concerned, in the month of April, after 1 to 2 weeks of some speculation, I mean, during that point of time, prior to leading up to the circuit breaker and everybody had to stay home, there were some kind of transactions. And I think because of things like that, media again decided to speculate, and they speculated in a way where, based on a bit more fundamentals and a bit of how the transaction volumes were going prior circuit breaker, they predicted home prices to not change. I think one of the other things that speculators predicted was, prices to remain unchanged because of how robust and certain kind of implementations the government had. Okay, I think as we all know, during the circuit breaker itself, definitely there were certain economies, there were certain industries that weren't doing very well. But I think as far as Singapore is concerned, as far as the Singapore government is concerned, they wanted to take care of, of the people. And of course, they came up with this resilience budget. Well, the resilience budget, I think, is something that has helped to cushion a certain sense of the recession. It has helped to cushion a little bit more of the economy. And I think, the resilient budget, as far as it's concerned, was launched to keep economies afloat, from your layman, small businesses, all the way up, to the financing companies, to even your MNCs. I think what we wanted to do and what the Singapore government wanted to do was to create certain sense of resiliency, right? And I mean, shortly after the resilience budget, and just to take note, the resilience budget at the start was a 48 billion. I mean, the monetary number was 48 billion, right? Certain things that they did was to increase the GST voucher payouts. They also froze certain government fees. I think for self-employed people, they were giving up certain enhanced job schemes, and they provided a lot more COVID-19 support. But shortly after that, shortly after the resilience budget was launched, they also launched the solidarity budget. Now, the solidarity budget, I would say, provided a bit more urgent support especially during that 4-week circuit breaker. The interesting thing about the solidarity budget is that there was another government ruling that tied together with MAS to allow rental waivers. Rental waivers, tax waivers. More importantly, they also allowed consumers to defer mortgage. I think one of the biggest things we have to understand as a Singaporean is that, the biggest asset we would have in our entire lives would be real estate. And I think the Singapore government has tried to cushion whatever fall, whatever drop in terms of the economy as far as the real estate market is concerned. And I think certain things like this has contributed in one way or another. I think we are a first world country for a reason, and I think with this continued government support, I think one of the biggest and most stable industries we've ever seen, we've ever experienced in our lifetime is and will be real estate. I mean, we've gone through a couple of slides. We've spoken about what has happened during the circuit breaker. We spoke about what the government has done, the certain implementations of certain enhancements to the economy. But I think what is interesting here, as far as the real estate market is concerned, is this big question: what has actually happened? How has real estate market fared during these times of uncertainty, right? So of course, the biggest news back then during the circuit breaker, especially, is we had a bit of an issue with the dormitory workers. I think at that point of time, during the first week or so, to us, it didn't really hit us in that sense where dormitory workers affected, but it doesn't affect us. But I think what's important and how it's affected the industry would be obviously the workers who are exempted, or the workers who have tested for the COVID-19. In a more layman spectrum of things, it would cost more money for them to come out and work, right? Of course, that being said, majority of the dormitory workers were quarantined. So, in actual fact, during the circuit breaker, there was some kind of talk about increasing construction costs. Of course, together with the fact that there wasn't Singapore doors weren't open, there wasn't materials coming in, so certain things like this contributed to the increasing construction costs. This was one of the very biggest hints of the market back then, which also fueled speculation. But what's interesting to note is that along the way, I think as far as the increase in construction costs is concerned, Singaporeans are very adaptable. We managed to overcome that. I think at this point of time, whatever that has happened, whatever cost that has increased, certain developers have taken that into consideration. But I would like to cover a little bit more on what was happening prior to circuit breaker, just to have a bigger understanding of the market in that sense. So, of course, prior to the whole pandemic, right, we actually saw a dip in terms of inventory. Inventory being new stuff, new land being released. As you can look at my chart here, I think we all know the en bloc frenzy happened in 2016 to 2018. What has happened more recently is in 2018 there was an implementation of the additional buyer's stamp duty, additional 5%, right? So with that, we saw a little bit lesser en blocs being carried out. We saw the government has also been a bit more tighter on the government land sale. So what you've seen in essence in this particular slide, you notice that in 2019, 2020, inventory is not as much as your 2017, 2018. And I have to explain at this point of time, whenever, and this is a historical trend. So whenever land bank decreases, to fuel the demand of real estate in Singapore, to a certain extent, the government will have to release certain land. So just to explain this particular chart, the whole purpose, purpose of this graph here is to explain that inventory has been somewhat scarce in the last few years, right? Of course, when I talk about the government releasing land to fuel the demand, I think many people, many questions, many consumers always ask, where is this demand coming from? I think one of the important things we have to understand about the real estate market in Singapore, especially for the last 2 years or 2 to 3 years, I would say, our demand is fueled organically. So probably stay in a HDB, probably the new flats. After 5 years, they look to exit. They look to upgrade their quality of life, or for whatever reason that they look to exit or to sell their HDB flats, right? More so, this money will have to come back into real estate. in one way or another. So when we look at the demand, and you look at this particular graph here, you will realize that in 2019, right up to 2022, there are potentially higher number of HDB upgraders, more so from the estates that are reaching MOP. For example, peak at Toa Payoh, for example, Dawson. We see more of these people exiting. Probably, the typical trajectory is after they exit, they go into the private residential market. So in one way, like I say, this whole variance contributes to an organic demand. And a lot of people always say, yes, the foreign monies are coming in, etc. But we have not seen that, or we have not seen a bulk of that in the past few years. I would say like the traction generally, as far as the transaction volumes are concerned, again, is an organic growth. And that says a lot about the market, right? I think the interesting thing about having to see all these, media, all these articles, and now that you've seen this particular organic demand, your thoughts will probably be like, yeah, so what is the real estate market sentiment? Like you haven't covered, where we're exactly headed towards and stuff like that. Basically, what I've been talking about in the past few slides are, the demand, what people are looking at, what people have been speculating. But I think it's interesting to find out about the real estate sentiments at this point of time. So I think we all know, right? This is a chart of the transaction volumes for the year 2020. As you can see where the balloon is in the month of April. April was where the start of the circuit breaker was. And I think what the circuit breaker was set out to do, of course, is not to lower transaction volumes, but of course, it didn't allow people to go out. Most of the show flats were closed, things along those lines, which is why we see a dip in terms of transaction volumes. But whether or not the market has actually been affected, it's a bit hard to tell just based on one drop in a month. If you see the gradual growth from the month of May, June, July, we have seen the market rebound in that aspect to certain pre-COVID levels. And I would say this, June, if you look at my cursor here, June was the month where the circuit breaker ended, right? I mean, they allowed certain show flats to be open, of course, with the safety distancing and stuff along those lines. And I think interestingly enough, you'll see at 1,000 units in the month of June, what we see here is we see a knee-jerk reaction. Okay, usually whenever there is a downturn, there's a bit of a pent-up demand, right? And this is, although the pent-up demand here is not strong, or is not as strong as it could potentially be, I think this says a lot about our market, right? Of course, the trajectory of transacted volumes, they've been increasing exponentially. What is very, very interesting to understand is typically, as a consultant, as an agent, I think the Hungry Ghost Festival is the kind of month that we dread, because the transaction volumes are usually the most, I mean, not the most, but the least in that sense. So it's funny because if you look at this particular article, in the month of August, during the Hungry Ghost Festival, we saw a huge sales surge, and it was the best Hungry Ghost Festival transacted volume year in 8 years. But if you can see, right, I think one of the strong points that you have to understand here is that the pickup rate was mainly led in the RCR. Now, I'll cover the RCR in a little bit, but I think this alone speaks a lot about the market. In the typical years, whenever there wasn't any pandemic, there wasn't like, any COVID-19 and things like that, August typically is in a calendar year or 12 months. August is the kind of year where most of us will see a very big decline. But I think when you talk about the whole pent-up demand, when you talk about that whole knee-jerk reaction I was talking about a while ago, I think as far as the Hungry Ghost Festival, is concerned, I think consumers didn't let that come in the way. That just really shows the appetite of real estate demand in Singapore. Of course, in the month of September, also very interesting. We saw a 2-year high, and again, this was the best month performance ever since July. Now take into consideration this. the circuit breaker, of course, in April, right? We would expect transaction volumes to be somewhat mellow, somewhat mud and capped. But it's interesting to see that again in the whole year, September was a big month. And mainly the transaction volumes happened because, like I mentioned a while ago, the pent-up demand, the attractive prices, and of course, the low interest rate as well. And if you see, again, based on where my RCR, very interesting thing to note. I think the important thing that I would like to stress here is what has actually happened prior prior circuit breaker till date. I think this particular article is not the most updated. If you see right on my left, 𝓚𝓸𝓬𝓴, right? This happened in the month of March, just before the circuit breaker. Now, if you look at consumer sentiments and you look at articles like this, especially for this 𝓚𝓸𝓬𝓴 development called the M, I think prior the circuit breaker, selling 70% of or 70% of the project just in one day speaks a lot of volumes about that demand. I know it's funny because during that time I was speaking to a few clients of mine, I was speaking to some of these analysts and stuff like that. They would say, yeah, it's not the kind of, the end is not near yet. It's just the the beginning. So if I were just to put things into perspective, during the COVID-19 period, of course, after the circuit breaker, there was a launch of Penrose, right? This happened in September. Now, again, 60% of the units were sold in over a weekend. So if you've noticed what I've spoken about, the pent-up demand, the knee-jerk reaction, certain things, and that is just the tip of the iceberg. I haven't gone into the detail yet. You would kind of have a certain sense of assurance about the real estate market itself, right? And I think importantly, if you look at this third particular article, the link at Beauty World, I think this was a complete test of faith during this pandemic period because obviously it launched late last year, 2020, and in one weekend we saw 96% sold. Just to reiterate the fact of that demand, especially being organic, I think this says a lot about the market. If you are a consumer today and you are still unsure of where the market is headed towards the next few months, I think my next few slides will answer that question, right? Of course, that being said, during the time that all these launches were launched, developments were sold, government and certain developers were still, in the business. In the business being, they were still bidding for land. Again, like I mentioned in my earlier slide, land has been decreasing. I think there's been a decrease in land bank. And again, to fuel this kind of organic demand that we've seen in the previous slide, I think this article speaks again for itself. Developments and land parcels in Tanah Merah, for that matter, their land bid prices kind of superseded the then current prices. I think this is very important to note because to a certain extent, if the government is very bullish with their thought and their direction of real estate, it kind of shows the direction that the real estate market is headed towards, right? And I think Tanah Merah, we should know 248.9 million is not a small amount. Okay, it's not a small amount, especially for today's market. So I guess at this point of time, what I really want to justify is that real estate in Singapore is headed towards a bit more of a bullish approach, or rather we are taking a very bullish approach to real estate. But in order to materialize this boom, usually there are certain fundamentals and there are certain telltale signs, that one consumer needs to pay attention to, which of course I'll be covering in my next few slides. Okay, I think one other thing that has really aided the increase or the spike in terms of transaction volumes are the low interest rates. Okay, how this works, I would just try to explain it in a few sentences. It's very interesting. Whenever the economy is weak, I would say, of course, certain countries would have to spur or stimulate growth, importing or exporting of maybe certain materials. That's how governments really make their dollar. So I think in order to spur spending, right, the whole macro point of view is the most simplest way to understand things is if the market is not good, but you want people to spend money, you lower interest rates. This is just a very layman. Of course, the most micro point of view is yes, central banks in America drop interest rates, which eventually led to all the other central banks in the world dropping interest rates. But the point here about low interest rates is to spur spending. And of course, today, if you are a consumer or you are an investor looking to enter the real estate market, when you look at the SIBOR or maybe even the normal interest rates going to as low as 1.25%, it kind of means that you can borrow more for less. So in one way or another, the low interest rates were also one of the big factors of people of the take-up rate of the transaction volumes per se. Even for myself, I refinance my own, develop my own units, and I'm not even paying anything more than 1.2% at this point in time, which again speaks volumes, I would say. Okay, it's interesting because at this point of time, I would like to ask people, everybody here who is paying attention and listening to this, what your thoughts of real estate are at this point of time. And I think to answer my question, you can put in the chat. There's a chat box. Just tell me roughly where you think that the market is heading towards now. Are we heading towards a bull? If you think we're heading towards a bull, please type 1. If you are heading, if you are going a bit more bearish direction, of course, type 2. But if you think we are plateauing, if you think the prices are tanking, please feel free to type number 3. This is just for my understanding of what the consumers think before I share with you the facts and figures. So I'm just gonna give you, okay, we got some people typing. All right, interesting. Some people think it's going to be a bear. Some people think it's going to be a bull. Very, very interesting. Okay, I'll tell you what I perceive the market to be. And I've been through a lot of the downturns. I've been through a lot of the, the high spikes. I think it's interesting to see what the market is, what the market thinks in that sense. So, of course, one thing to take note, the difference between the real estate market now and the difference between the real market, maybe say 7 years ago, is most of the speculative market is gone. Now, what is a speculator? In a very layman term of understanding, the speculator is an investor without the holding power, meaning to say, I can buy, but assuming something happens, I cannot afford for my unit to be vacant. So that's what a speculator means, right? That's what a speculator does. So I only have, assuming 25% deposit, I max out my entire loan 75%, and that's it. I have no rainy day fund. I have nothing. So in essence, my investment or my asset would fare or would be exposed to the economical sentiments, right? And I think one thing to understand why the speculative market is gone is really because of the past few implementation of cooling measures. I give again real-life scenarios of what has happened. I think with every inception of the cooling measure, we've seen the market tank for a little bit. We've seen a lot of uncertainty. But I think what has really happened, especially as far as the cooling measure is concerned, is that the cooling measures are here to set up or to set about a more resilient growth in terms of real estate prices. They are also here to eliminate the speculative market. The main difference here, again, in a very layman context, would be 7 years ago, the loan to value was 90%, right? Buyers could easily buy $1 million property, only need to pay 10% down payment. That's how it is. Throughout the years, of course, the LTV has dropped to today. The loan to value, which means the maximum loan anybody can take is 75%, which means your deposit is 1/4 of the purchase price. Now, this may or may not have an impact on you who's listening here, but what this has actually done to the consumer is this has forced the consumer to be very frugal in their purchases. And of course, being frugal is the number one, I would say, cushion for a recession like this. Meaning I buy something that I can afford, whether it's a rainy day or whether it's not a rainy day, right? And because of all these cooling measures, your ABSD, it has also kind of killed that big spike in terms of growth, right? Again, to reiterate what I said a while ago, all these implementations of the cooling measures and your loan to value, your TDSR, total debt servicing ratio, is really just to ease that trajectory in terms of price increase. Again, to put it in a very interesting way, I think I hear this a lot. I hear this from my clients as well. They always tell me, say, hey, Kenji, the real estate market is growing at such a high pace, but my salary is not growing at a high pace. So this is exactly one of the other reasons the government has tried to create a more resilient approach as far as capital appreciation is concerned. You know, so in the last 3 to 4 years, we've seen all these cooling measures come up, right? It has come to a point of time where if I have bought something at the start of the cooling measure till today, assuming I bought something at 2 million, if my job, if my phase of life is the same, nothing has changed, I'm still with the job and stuff like that, it doesn't force me to sell my unit at a big discount. More so, it allows me to hold on to my property for a longer period of time. And if you look at the typical transaction volume or the typical transaction numbers, I would say, in terms of quantity, we would realize the bulk of these numbers fall between the 1 to the 2.5 million quantum. This, of course, is taken into consideration most of the people who buy, they buy for own stay, things like that. So in an essence, right, what has actually happened with all these cooling measures, it has kind of recession-proof your smaller quantum units. Of course, there are still fire sales happening around the market, but typically things like that happen for the 5 million quantum and above. But that being said, even prior to circuit breaker, even prior to COVID-19, there was always fire sales at 5 million and above, right? And I think the important thing to understand is that from then till today, from the start of the cooling measures 4 years ago till today, we've only seen the market grow strength to strength, from strength to strength, which again is very dependent on our organic growth, right? So the organic demand in that sense. So it's very interesting because like I mentioned at my first slide, I think most of my clients today are, they hold very different kind of portfolios, but mainly they hold a bit more of the investment kind of portfolio. What I've learned, and I think this is again applied to my own properties as well, right, is typically as far as capital growth in Singapore real estate is concerned, of course, we see there are two biggest fundamentals. Number one, economy. I give you an example of economy. So basically, like now, we've kind of hit rock bottom with economy. We're in a recession, right? Only economy can give us capital growth per se. So assuming the economy becomes a bull, right, in the next 3 to 4 years, market recover, economy does well, you generally will see the market prices going up as well, the real estate market prices for that matter. But one thing about economy, you have to understand, economy is based entirely on time and space. We can only predict so much as to how the economy is headed towards, right? So we can say that market is going to become a bull, etc., etc. But again, if there are certain countries that don't look eye to eye, they don't see eye to eye, economy may dwindle. The most important thing to understand that economy is beyond our control, right? Economy in that sense is something that if you have a piece of real estate and you hold it and you buy it in the bad times, right? In essence, when the good times come, again, in a very layman context, that's how you would see, of course, your first set of capital appreciation. I think what's more interesting to find out is infrastructure, because I think as far as infrastructure, with the correct planning and with the correct development, I would say you would be able to capitalize more from a consumer's point of view. Now, why I put this particular slide, why I purposely talk about Next and 𝓚𝓸𝓷𝓰'𝓼, because again, these are things that personally I have to overcome. Personally, I've been through this particular phase. I think we all know that the 𝓚𝓸𝓷𝓰 in the past, at least for me, it used to be a graveyard, right? Nobody ever thought 𝓚𝓸𝓷𝓰 would become what it is today. But long story short, I think if we were looking at real estate in 𝓚𝓸𝓷𝓰 area probably about 5-6 years ago, it would not be at today's price. Today's price, we can see, of course, like your Woodleigh residences, things like that, things are transacting at 2,002, 2,003 per square foot, right? And 2,002, 2,003 per square foot is the current market sentiments based on whatever that's built there, based on the URA master plan, things like that. But that is what infrastructure is all about. Why you see I put this picture on the wall next. It's a very interesting story. I think a couple of years ago, maybe about 8 years ago, I sold a unit opposite next. It's a HDB 3-room flat, very normal, 3-room flat. I sold it at 260,000, 270,000. Right. Fast forward 6 years later, after Next was up and running, I sold the same unit at 570,000. So I think that alone speaks about infrastructure. I think that alone shows what infrastructure does to you, assuming your KPI is I want to make money from real estate, right? As far as the own stay element is concerned, of course, that one you have to look at. You have to look at layouts, you have to look at amenities and stuff like that. But I think what is very interesting to note, whether the market has been a bull, whether it's a bearish market, or whether we are in bad times, right? Most of the time, we will always understand, especially for developments that are closer to amenities, they are closer to your MRT station. These kind of developments that are very close, we will always have the most resilient growth in that sense. Again, it's a very interesting layman understanding. Just to give you an example, so if you look at just normal rental transactions, right, you would notice, again, in the past few months, there were a lot of rental speculation, like rental market dropping, etc. But it's interesting because when you see the entire market on its own, the rental prices for developments that don't drop are for the developments that are very close to the MRT stations. They're also for the developments that are very close to the shopping malls. So in other words, I think if you were looking for a shorter term tenure, or you're looking for the shortest tenure, biggest ROI, then you would probably be looking at certain things like that. But more so, you would be buying into an area, or you would be looking at an area where there is upcoming infrastructure. And when I say infrastructure, of course, the bigger the infrastructure, the bigger spike in prices you will probably see lah. Right? I think this is interesting because Marina Bay Financial Center is one example of a very big infrastructure. I think most of you here, I don't know if you know this story lah, but basically we all understand, or we all know that Marina Bay Financial Center was the biggest project last time, probably about 20 years ago, thereabout. Right. So what has happened is, they have been reclaiming land. Everybody at that point of time thought that, it's just going to be another plot of land. But what people didn't realize at that time is that this plot of land is next to Tanjong Pagar Shenton Way. And Tanjong Pagar Shenton Way was our CBD 1.0. Right. So this entire thing that you see here, MBFC area, this is what it is today. And this has become our CBD 2.0. Okay, of course, 2010 was a year that the whole MBFC area got ready. They kickstarted at that point of time. And I think, of course, we have certain icons like your Marina Bay Sands, your Gardens by the Bay. But it's very impressive. What I'm trying to say is the entire transformation, the entire infrastructure that has taken place. I think it's very different. And, it's interesting because back then in 2011, when I was selling the MBFC condos in the area, I used to always get into debates with investors who were telling me that 2,200 or 2,400 was expensive. Fast forward today, of course, MBFC is not in that price trend anymore. We've surged way higher. I think we've broken out of that resistance bubble. And you can see this is what it is today. Of course, it is one of the symbol, of a 21st century Singapore. And I think this story is a very wonderful story to tell. This story, of course, is one of those that, assuming you bought it in a day, you would be laughing now lah. Okay, but I think what's interesting to find out that Singapore, as far as Singapore is concerned, the government it's very interesting how the government always tries to capitalize on certain areas and try to build certain areas in that sense. Okay, I think that the most important thing I wanted to speak to you about infrastructure, as far as infrastructure is concerned, would be the next biggest Singapore infrastructure. Okay, for those of you who don't know, the next biggest infrastructure in Singapore would be called the Greater Southern Waterfront. Now, Greater Southern Waterfront basically comprises of 3 components. Just to give you an understanding of how big Greater Southern Waterfront is, right? It is about 6 times the size of MBFC. It is going to be divided into 3 components. Obviously, one, your live component. The other one is your play component, and the third one will be your work component. But I'll explain that in the next few times to come. So just look at this, my cursor. This area will be your MBFC area. As you go all the way here, Vivo City, somewhere here, And it's quite a very big and vast kind of upcoming development. Of course, what we will see as well as part of the Greater Southern Waterfront change is that the terminals will be moved to Tuas by 2027, of course, participating by 2040. But this whole idea that the government has is to create, like I mentioned just now, live, work, play, right? The live, work, play element is very interesting. It's interesting because it almost is going to be an entire economy on its own. So just to give you an understanding of how big it is, right? So it stretches about 30 kilometers along the coastline. It's about 2,000 hectares of waterfront land. Okay, everybody, okay, some of you at this point of time may say, yes, 2,000 hectares of waterfront land, but we are an island, right? So of course, island, you would have waterfront land here or somewhere there. But the difference that makes the Greater Southern Waterfront stand out is that I think of where geographically is located. So again, we are close to your CBDs and stuff along those lines. But like what I really wanted to talk about as far as your live, work, play is concerned, you would realize that as far as live component is concerned, right? Let me see the next slide we have. Okay, yes, the live compartment. So as you can see, this particular article says the current Keppel Golf Club, the lease is expiring this year, right? And that land has already been confirmed that, you know, government has already confirmed that it will be moving out. They are taking back this land and it will be zoned residential. Okay, the zoning residential may mean where it may mean maybe the private residential, maybe, you know, your $1 million BTOs. We don't know, right? But what we know is that entire golf club land is zoned residential. So that becomes your live component, right? Your work component, sorry, your play component, I would say you kind of want to understand this because your play component would be things like your Sentosa. As we speak, Sentosa is actually expanding half size more. The IR in that sense is expanding. But it's interesting to find out, if you can see my cursor here, this small island, Pulau Brani, they are also converting and they are in the midst of converting. So essentially we will find like a smallish East Coast park in that area. So again, as far as gentrification is concerned, I think the Greater Southern Waterfront brings the term gentrification to another level, right? So you have your live component, you have your play component being Pulau Brani, being Sentosa. We also have your work component. Now, let me just go back to one slide. I want to explain to you. Okay, this slide. So again, just to explain, right? Golf club, you can tell the golf course is here, is moving out. This will be your live component. Play component is here, where my cursor is, your Pulau Brani and you know, your Sentosa. Now the work element will be from here, where my cursor is, all the way here. And this area would be your grade A offices. It would be your, you know, hotels. And generally what we see from this area is much like what I mentioned before, Shenton Way being your CBD 1.0, MBFC being your CBD 2.0. Now this area that you see here, this work element in the Greater Southern Waterfront is what we think would be your CBD 3.0. And again, I think as far as infrastructure is concerned, it is very, very vast. And to explain to you again, to put it into context of what exactly is happening at this point of time, number one, we know the golf club, the golf course is moving out end of this year. So that is as far as the start of the Greater Southern Waterfront. From the office space, as we know, St. James Power Station has already been, you know, it's not St. James Power Station anymore. It's currently the headquarters of Dyson. And it is, if you can tell, that would be the start of the entire CBD 3.0, which is again about 3 times the size. Just the work component alone is about 3 times the size of MBFC. Now, as far as infrastructure is concerned, you know how real estate works. If there's an MRT today, developers sell it to you with the price of the MRT already included. But of course, if you buy something in that sense where there's upcoming infrastructure, maybe you might be inconvenienced for the first 1 to 2 years, you know, before this infrastructure is mature. You would be buying it at the then that kind of price where you don't pay a premium for it and certain things like that. So Greater Southern Waterfront, in essence, what is happening It is going to be this major infrastructure that's going to contribute to a lot of growth. And when I say growth, it doesn't just mean growth for the real estate market. Of course, there'll be growth for the companies who's going to be working there. When you have new plot of land, when you have new office space building out, of course, certain economies thrive in that. What we're anticipating from this entire move is that we'll be anticipating bigger traction to the area, bigger eyeballs as far as real estate is concerned. But we, of course, would see the market spike. But just to again explain how the market spike comes along, we are not going to be expecting, the spike in a year or, a couple of months. Like what the government has set up to do to create a more resilient growth as far as that's concerned, that is how we're going to be looking at the market in a few months to come or the few years to come. Right? I think, yes, this is like what I mentioned a while ago for the whole Greater Southern Waterfront. This is the artist's impression of Pulau Brani. So it's going to be a bit more like a water park, like an East Coast park, things along those lines. Okay. I think more importantly, I would like to also speak about Keppel Bay. I think Keppel Bay has always been very misunderstood, in my opinion. Whether it's been misunderstood or not, I think Keppel Bay is a very iconic locality, especially in Singapore. I think we all know if we go there over the weekends, we go jogging, there's a park. It basically gives people a different quality of life in that sense. We won't tell our friends that, hey, we are going to Changi Beach to go to the beach, right? We always say things like we're going to Sentosa to the beach and stuff like that. So I guess, again, that sets Keppel Bay aside from everything. But let's debunk some myths along the way. First things first, we understand what is Keppel Bay. So Keppel Bay, there are a few docks. Just to explain to you a little bit of the history, I would say. Of course, in the 90s, there were a couple of docks there that were there to service ships. So again, we've got certain heritage, right? We've got heritage, we've got history in the area. It's not like a new estate where, example, Bidadari, right? So that one, the history was that it was a graveyard. Keppel Bay is different. Keppel Bay, again, rich in history. It used to be there used to be a channel for ships to come through, service their ships, resupply and stuff like that. Of course, that was in the early 90s. In the mid 90s, right, when you look at this, just of course you take note, Singapore used to be a trading hub in Southeast Asia, I think, with ships and stuff like that. So here we have Queen's Dock, we have the Keppel shipyard. This is what it looks like in the 1950s. So again, this is just to further reiterate the history of Keppel Bay. I think what's interesting to note is this is the Keppel Bay, the present Keppel Bay. Of course, we have the biggest icon here, Reflections at Keppel Bay. And then you have your Caribbean, you have your corals, and of course, we have certain upcoming developments, which I'll talk to you in a while. But what has happened in the last 20 years in Keppel Bay is that we've transformed from what was just a normal service dock to a world-class waterfront facade. Right? When you talk about world-class and you talk about waterfront facade, only a couple of countries come to your mind. Monaco, south of France, that kind of stuff, you know what I mean? But I think Keppel Bay, like I say, in all its honor and glory, I think Keppel Bay is also belongs to a certain class on it in itself. And whether we like it or not, like I mentioned a while ago, it's iconic. Okay. Of course, I mentioned again, world-class waterfront living. This, as far as the future is concerned, I think the future of Keppel Bay, we kind of know, as far as I mentioned a while ago, the Greater Southern Waterfront. If you look at this picture on the left, it's interesting because this is a picture of Mr. Lee Hsien Loong during his National Day rally speech in 2019. So this is exactly where he was talking about the Greater Southern Waterfront, the impact that it would have, on the Singapore economy and stuff like that. Personally, what I feel is that now that we are in a recession, I think that certain economies which have been affected will need to rise very quickly. And I think as far as, the government having to cushion the economy per se, the entire economy in Singapore, they would probably need to expedite this entire infrastructure just to get Singapore back on its feet. I think that is one thing that we would expect. Of course, that being said, if we look just purely time and space, then your golf club, the Keppel golf course, it is probably going to start end of this year. right? But that being said, what we are looking at is, I think, with whatever that's happening in the market today, we would expect the Greater Southern Waterfront to, number one, be expedited in that sense. They probably will focus a bit more on this in the next few years to come. Number two, of course, is to create certain growth in the economy. I think very interesting to note is, typically, if you have already been in Keppel Bay, if you know about developments in Keppel Bay, you probably have your own mentality about the area. Personally, like I mentioned a while ago, it's a very misunderstood estate. Okay, so the whole history here is, when I started real estate, Keppel Bay was one of the places that really captivated me. I just, to a certain extent, I just feel that there are characteristics which are very good, but there are certain characteristics that we cannot help that has caused Keppel Bay throughout the couple of years to be a little bit more volatile. Of course, first things first, we have to understand developments that were launched earlier, right? Like I mentioned earlier on, back then, loans were given out easily. High loans were being given out even easier at 90%. So when you look at developments, especially in this area, that were launched in 2006 and 2007, they were launched at a very speculative era. And throughout the time that they were launched, the economy in Singapore had to overcome a few drops, especially during the SARS period, especially during H1N1, things like that, right? But what in essence you are looking at here is, again, because it was launched at a speculative era, we noticed that the people who were not able to hold had to kind of sell at a bit of a loss or at a bit of a discount, which caused the entire trend in that area to be very volatile. Okay, over leveraging was very common at that point of time. I even had clients who did 90% plus 10% loan, but when all these things are done, it's not allowed to do anymore. But things like this, borrowing money to buy something that you cannot, you have no power to hold. This entire spectrum of speculation, right, is what caused the entire area to become very volatile. And again, I think also moving forward, after having all these kind of implementations of the cooling measures, is really to eliminate this speculative spectrum or this speculative bubble. Again, to reassure the consumer that prices are on a slower or more resilient upward trend. Okay, of course, like what I mentioned a while ago, after the implementation of the cooling measures to Singapore real estate, I think very, very good example to take note is Corals at Keppel Bay, because Corals at Keppel Bay was launched towards the end of the speculative bubble already, right? It was launched at an era where most of the ABSDs was already implemented, right? I think one thing you have to understand as well, what you constitute a good development, of course, is rental yield. And I would like to show you in my next slide. So this is taken in a year, 1 year. Take note, there are only 300-ish units at Corals at Keppel Bay. But in the year 2020, we've seen 81 transactions for rent alone. Now, the reason why I'm showing these particular transactions or this transaction slide, right, is because throughout the course of my industry, throughout the course of my work, I've had a lot of consumers, a lot of investors coming to me asking me, Kenji, what is a good investment asset? Do you think that 𝓚𝓸𝓬𝓚 or freehold is better than 99? I think what is important to understand is that the way a good development is being defined, of course, number one, resilient capital growth, number one. But what actually the biggest fundamental of capital growth, I would say, as far as being a good development is concerned, is healthy transaction volumes. I'll give you a scenario so you understand exactly what I mean. So assuming I'm an investor, I buy Corals, right? And I rent it out. Say I rent it at the normal price. I buy it for about 1.6 million, assuming I rented it at 4,500, which is normal, is healthy, right? So me as an investor, because my rental yields are strong enough to, to sustain itself, I won't be forced in a certain scenario to sell it at a loss. So when you have 10 people or maybe even more looking at developments like that, having the same mentality where, okay, I buy a development that gives me a strong rental yield, I won't be forced to sell. So that is exactly how prices, again, to define how you define good development would prove. You won't see big drops in prices. You won't see big spike in prices. But what you would see is you would see a gradual upward trend as far as prices are concerned. But again, to understand this fundamental, why I keep talking about the rentability of things is, it's simple. If I was a tenant, right, or if you guys here were a tenant, you would, and you're not driving, right, you generally want to find or rent a place or a unit that is close to everything. It's close to your train station, so it's convenient. You would rather pay a higher rental to make up for these things than to buy a car, etc. This is again a very layman consumer sentiment. So I always tell my clients that if you are looking for growth, okay, if you're looking for sustainability as far as rental is concerned, buy something. It doesn't matter whether it's 999 or 99. Buy something that's close to MRT station and malls. But unfortunately, in the whole land bank spectrum of the government, we always know that your 99-year land parcels are closer to the MRT station and malls. Your freehold units are usually a little bit further out. So that's how it is. I mean, at the end of the day, it really depends on your direction or your consumer's direction. But in essence, when people look for units to invest, when they look for properties, as far as growth is concerned, something that's a bit more steady, they look towards the amenities. And I think corals is a very good example, because if you were to compare corals, Caribbean reflections, not to say that reflections is not good. I love reflections; it's very, very beautiful. But I think as far as investment, there's a reason why corals is very heavily transacted as far as rental use are concerned. Of course, because it's the closest to your MRT station, it's closer to the malls and so on, right? Okay, interesting thing. I think the highlight of tonight, the highlight of me speaking to you guys, of course, to explain to you what else is available and upcoming at Keppel Bay. So, I think without further ado, I want to introduce you the Reef at 𝓚𝓲𝓷𝓰'𝓼. Now, the Reef at 𝓚𝓚𝓲𝓷𝓰 is a very interesting development. Again, in my very own personal experience. So I have sold a lot of units at Reflections. I sold a lot of units at Caribbean and Corals, but I think that is quite nothing like the Reef at 𝓚𝓚𝓲𝓷𝓰'𝓼. Okay. First things first, just now I mentioned about the Greater Southern Waterfront. What we want to understand, if you look at this entire graph about the Greater Southern Waterfront, the Reef at 𝓚𝓚𝓲𝓷𝓰 is right smack in the middle. Some may call it the heart of the Greater Southern Waterfront. But I think to me, what is more interesting to know is that we are built in an area that is already mature with the potential to mature even more. So if you look at the current market sentiments, if you look at the current inventory in that area, as far as supply is concerned, we don't have a lot, right? This is one of the very last, and again, it is happening in the middle of the Greater Southern Waterfront. So in other words, if I was a speculator, if I was an investor, I would want to buy something where, again, I would overcome economy, I would overcome infrastructure. So I think the Reef at 𝓚𝓚𝓲𝓰'𝓼 is going to be very interesting. Let me just move forward. This is just a micro map of the Reef at 𝓚𝓚𝓲𝓰'𝓼. It is the closest and the last significant plot of land that is closest to the MRT station. Of course, it is about 2.5 minute walk to Keppel Tower. And of course, when we used to sell corals, and please take it with a pinch of salt, right? So when I used to sell corals, and I still am selling corals, I personally think that's a very good development. It's brilliant. It's really nice. It's also very close to the MRT station. But I think now that Reef at 𝓚𝓚𝓲𝓰'𝓼 is here, as far as proximity to anything, this is probably one of the more interesting developments. Okay, like I mentioned a while ago, this is the last sizable waterfront plot in Keppel Bay. When we say waterfront, I think it's interesting to know, because what we mean, right, is you are literally at the water's front. So if you hop off the railing, you drop into the water. That is waterfront. The difference between us and the upcoming Keppel Golf Club land is that they are still in the same vicinity, but they are not the waterfront kind of development. So I think that's interesting to know, right? And I think besides us, there's really no others. This is just to show you what we are close to. So where you see this red icon here is the Reef at 𝓚𝓚𝓲𝓷𝓰'𝓼. We are about 2.5 minutes Keppel Power, which essentially we are the closest to your Vivo City, your Harbourfront MRT station. Again, for those of you who are investors sitting on the fence, I think this is something that will be very interesting. I think this is something that, as far as resiliency goes, plus infrastructure, I think this gives you a lot of possibilities as far as enlarging or getting back a bigger ROI is concerned. Okay, the other thing I want to explain, of course, this is a bit more of the feng shui element. I don't know if you guys may be into feng shui. Personally, I'm not that into feng shui, but we always have this Chinese saying, right? So your front faces the sea, your back faces the mountain, etc. So we are about 300 meters from Mount Faber. This is a very, I don't think they plan for it. I think generally this is what it is. It is a bit more of it was just geographical that things like this happen, but I feel that it's a need to explain it to you. I've often had clients going into the units with me and they bring along their feng shui master. So I guess, again, if this is your thing, it can be very interesting. But what I essentially want to show you is that you've got the sea in front of you. You've got nature behind you. And you are in between your MBFC and you're in between Mapletree, Pasir Panjang. Quite honestly, there's nothing more that you can ask for. I think as far as the having fundamentals for increasing your ROI, I think the Reef at 𝓚𝓏𝓮𝓯 is something that will be very palatable. Of course, the important thing we also want to explain to people here is that, for the longest time, there's always speculation of when will we be launching, stuff like that. So the Reef at 𝓚𝓏𝓮𝓯 is confirmed launching on the 16th of January. Okay, it's right in the heart of the Greater Southern Waterfront. I don't need to explain that much. And it's starting from very attractive prices. I think prices I will explain in a short while. I think what we also want to understand about the Reef at 𝓚𝓏𝓮𝓯 is that it brings a certain class of life, or it brings a certain quality of life. But personally, I feel that you don't have to break the bank to buy it. I think given the way I've explained the entire session today, one other thing that I did not list down is scarcity of competition, I would say. And I think, interestingly enough, at the Reef at 𝓚𝓏𝓮𝓯, it's a spoiler alert, but our facility deck lies on a floating platform. So this is one of the I think the biggest proprietary thing, and the biggest thing that's proprietary to us. I think this is one other thing that keeps us and makes us a bit more of a world-class waterfront development. I think if you have any questions at this point of time, or if you have any questions about the Reef at 𝓚𝓏𝓮𝓯, or should you want to register for a VIP preview, please contact the ERA agent that invited you today. I think I'll be more than interested to explain to you on the ground, on the site again, of what's happening. Okay, of course, this is something I don't have to say more. Most of the time when we go into a show flat or we go into a unit, the biggest stumbling block to any consumer is price. So all I can tell you, if price is going to be a stumbling block for you, we have certain news from the developer. You don't have to break the bank to stay here. I think our one bedrooms are about 900 starting. They start from about 950,000, 950,000, sorry. Of course, and then your two bedroom starts from about 1.5x million. So it is, honestly, from a quantum perspective, it is not expensive at all. We have seen certain developments where they are a bit more heartland, fetching about 2,002, 2,003 per square foot. So for us, I would say we range, again, you have to understand, because Reef at 𝓚𝓏𝓮𝓯 is a very price sensitive development. Obviously, the closer you go to the sea, the more expensive it becomes. But it doesn't mean that it's going to be expensive to a point where it's not palatable to the typical consumer again. So yeah, I think it's interesting. And I want to say this again, if you haven't registered to view the Reef at 𝓚𝓏𝓮𝓯, please contact your ERA agent to do the booking for you. I would be really glad to see you guys this Saturday and Sunday.